This shouldn't be happening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, the economy is facing devastating consequences as stress inside the banking system continues to surge higher. And this is something that is not supposed to happen, because you could only imagine just what the effects would be on consumers and the broad economy if we were to see further bank failures at this point, which we're going to make the case in the show today that can absolutely happen, and perhaps we're on the cusp of seeing further bank failures. But will that be enough to get the Fed to turn around and pause rates or perhaps even cut? Well, we'll take a look and see what they're saying about where they're going with the June meeting. And meanwhile, of course, we're seeing now from the large commercial banks and investment banks, they're now saying that if we have a recession, that the damage to the labor market will be far worse than even we thought. But before we get to all that, we're seeing a still further collapse in consumer demand. And for that, let's head over to CNBC, where we picked today's story up with a headline: Foot Locker shares drop a whopping 25% after a big earnings miss and lower guidance. And we continue to see this outside of the headline government data that we look at, of course, as it comes out every month. What are we continue to hearing from these earnings reports and from these companies is just an outright collapse in demand, making us wonder how many more months it will take before that's actually reflected in the government data. Because if this doesn't turn around, well, it says we're headed to recession far sooner than many experts thought. As our sales have since softened meaningfully, given the tough macroeconomic backdrop, causing us to reduce our guidance for the year as we take more aggressive markdowns to drive both demand and manage inventory. So what we're hearing from Foot Locker is saying, look, not only do we have too much inventory, which of course we knew based on the data, but demand is so much weaker than we thought. We're having to aggressively cut prices. My friends, that is not inflation, that's disinflation, and potentially in some cases we'll see outright deflation if this inventory out of these companies just doesn't move. And Foot Locker's margins are already under pressure. Heavily discounting and theft-related shrink shaved 4 points off its margin in the first quarter. If you can only imagine, the company expects promotions will have to continue and pressure margins moving forward. So what we're hearing from Foot Locker isn't that we had a lot of inventory, we cleared it down. What we're hearing is, look, we have a lot of inventory and we haven't cleared it down. Despite aggressive discounting, we're going to have to do even more discounts to get this down. And now you're seeing why their stock price is crashing. And you can again only imagine we head into a recession with a massive inventory overhang. It will lead to massive amount of unemployment and huge markdowns, and potentially, as we're making the case, outright deflation. But one thing that shouldn't be going on is still happening is the stress inside the banking system. And to that, let's head over to Zero Hedge with this headline: Fed's emergency bank bailout facility hits record high as money market inflow suggests deposit run is not over yet. Now, one thing that we should try to understand here is if stress in the system is going away, well, what you should see is that banks are paying off these various loans, whether it's to the Fed, the FDIC, or the Federal Home Loan Bank, or whomever they borrowed the money from. What we should see is a decrease in the usage of these facilities. But one thing we were not expecting to see, or at least the experts weren't, was further deposit flight. And if we made the case on the show, as long as the Fed continues to raise their federal funds rate, they're putting themselves in direct competition with the banks that it doesn't want to see fail, because as money market rates go up, particularly the ones that are backed by the Fed, what are we seeing is money leave the banking system. And sure enough, it hasn't stopped at all, putting this essential situation here that more banks could be on the brink of failure. With regional bank stocks squeezing higher, one thing Zero Hedge notes is money market funds saw $13.6 billion of inflows, pushing the aggregate record high of $5.341 trillion, suggesting the question is, what are investors looking at? Because flows out into money markets are rapidly increasing. Again, that's over $520 billion in inflows just in the last 3 months, suggesting these banks are struggling to hold on deposits, which makes sense because they can't compete with these money market funds. Now, one of the challenges, of course, as we've noted in past shows, is these banks are sitting on large unrealized losses. And we can go to this chart here of the 30-year Treasury yield, looking at where we would see these stress in the system. We can go back to January and we can see this is where rates got up to, around 3.9%. And then what happened in March, they came back to 3.9%. And that was enough stress in the system to cause banks to fail. And now look, the market, participants in the market believe that rates must go higher. And yet what they're failing to see as they force and drive rates up, that all that's doing is putting more stress on the banking system. Perhaps they're short the banks. I don't know. What do you think? Do you think these market participants, these speculators, are deliberately driving rates up to cause some other things to break so they can make money? Or do you believe that, hey, maybe rates are just supposed to go higher and whatever happens in the banking system happens? But now let's take a look at the usage of these Fed facilities, because it's staggering what we see here. Looking at the discount window, this is short-term money you borrow from the Fed, and what we want to see is usage of this dropping down, and that's exactly what we're seeing. But what we're not seeing is the overall level of the money the banks are borrowing go down. So what this is telling us from the regional and small banks and mid-sized banks is the problem isn't getting any better. What we should see is deposits flowing back into the banks and then paying down these loans because they don't need them, and we're seeing just the opposite. So if you start to look at the broad picture here and you say, wait a minute, we're heading into a slowdown at a time when the banks are under duress. Well, what does that mean? Well, as we're making the case, even more failures are coming. And here you can see a breakdown between the three discount window usage going back to what we'll call nearly normal. But look at the bank term funding program. This was the Fed's program. If you don't remember what this is where the Fed comes in and says, look, we'll take your treasury and mortgage-backed securities off your hands for up to a year in exchange for cash. So what we shouldn't be seeing is the banks needing cash. But when you go back to where we started with this article, that more money is flowing into money markets, well, the banks are desperate needs for cash. The question only is, how much longer before we see another one go insolvent? And even the U.S. Central Bank had $96.1 billion of loans outstanding to the financial institutions through two backstop lending facilities through last week, compared to $92.4 billion. So you can see here they kind of paid those down, and now they're moving back up again. This is showing major problems still exist in the banking system. But you may remember from yesterday's show, there's this concern about this liquidity crisis made by some of the experts suggesting that there is going to be a drainage of reserves in the banking system. Well, now we have the latest report on reserves in the banking system showing a whopping $3.2 trillion sitting at depository institutions sitting at the Fed. So even if the Treasury were to issue $1 trillion of T-bills and nobody showed up to the auction and the commercial banks had to swallow it all, they have more than enough reserves. Maybe making the question is, why are people panicking about this when it shows the system just has plenty of cash? It's just the cash is held in all the wrong places. It's the small and mid-sized regional banks that need it, not the big commercial banks. And here we now go over to the Fed, wondering what they're going to do. And we're seeing the Fed officials are considering skipping a hike in June, but they're saying don't call it a pause because, well, they're looking at further raising rates here because they just don't actually see the stress in the system that they're regulating. But one thing that you shouldn't skip is the opportunity to sign up for CTA-Timer Pro. There's a link in the description below, because when you do that, you'll find out that you're going to be skipping out on buying high and start buying low. When you look at the report this week alone, we already put out a midweek note for people to help them figure out, hey, this is the ones you should be looking at. These are the ones to put on your hot list. We'll have one coming out over the weekend for subscribers. Again, it's $30 a month, risk-free 30 days. Don't like it, we'll give you your money back, but check it out. You'll see it'll change the way you trade. In contrasting remarks on Thursday, Governor Philip Jefferson outlined the dovish case for patience, while Dallas Fed Chief Lori Logan suggested she's not ready to call a halt to the Fed's tightening campaign. An option she floated is skipping action next month. So you gotta love how they're positioning it. Well, we need to kind of raise rates, but maybe we need to sit back and relax. So how do you position the market when you're completely uncertain about what you might do? Hey, we'll just call it maybe a skip. And if we skip one, maybe we can skip skip 2 or 3, but for the moment we're going to skip 1, but we still want you to think we're hiking because we're not done with this inflation fight, making us wonder, can the Fed even bring inflation down? Because there's an argument for caution alongside concerns recent strains in the banking sector, which we just outlined, could dent the economy, particularly if we see more bank failures or that leaders in Washington fail to raise the debt ceiling, that being unlikely at some point. They will, because the negotiations are continuing. But even if a mild recession comes with a steep price, now we're seeing the banks are saying, look, the job losses are going to be steep here. And a lot of people have not been predicting that because they're saying, look, the labor market's so tight. And we've been making the case of, look, it doesn't matter if demand falls off the cliff and you start to look at companies like Foot Locker that have massive inventory overhangs, falling sales. At some point, you don't need people to work your stores if nobody's coming in and shopping in them. And here we can see, using a jobs calculator developed by the Federal Reserve Bank of Atlanta combined with forecasts for peak unemployment, here's a look how job losses could accumulate. And among economists who expect a downturn, the average of 15 predictions suggests the U.S. economy will shed a whopping 1.7 million jobs over the next year or so, roughly 120,000 a month, or on net, you're looking at 30,000 people a week losing their job and not having an opportunity to get back at the labor market. That is definitely going to cause deflation. But those outlook is actually kind of rosy, as B of A is predicting a recession beginning at the third quarter of this year, which causes the unemployment rate to hit 4.7%, which would equate to roughly 97,000 net job losses. That one being a little optimistic, but how about Deutsche Bank saying, look, they think we're in the final months of this year, the employment rate hits 5.5%, and by then that's 140,000 net job losses, total 2.1 million. Either way you spin it, everyone's starting to realize that the labor market isn't as tight as we think. And of course, we're standing by the view that as initial claims head higher, break that mythical 250,000 weekly level, that what we should do is start to see the economy unwind. But will that give any hope for the Fed? Well, maybe rates could actually be going back down. A new normal for rates? Well, not so fast, says new Fed research. The Federal Reserve Bank of New York President John Williams said during a research conference hosted by the central bank that a widely followed model used to estimate the inflation-adjusted neutral rate of interest showed there's no evidence that the era of very low natural rates of interest has ended, and this is contrary to what many people believe is just a cyclical bottom and what will be much higher rates. We're saying, look, due to the yield curve, due to the design of the monetary system, rates are going back to zero. The question is, does this neutral rate, or the level the Fed has to raise rates to cause inflation to go down, is it even real? Well, if you look at this chart here of the consumer price index in blue against the federal funds rate, you see that there's almost not much of a relationship other than the fact that the Fed raises rates a bunch, inflation continues to go up, they start cutting rates for some strange reason, and then they cut rates even more. You can see that in the late 80s, you see that here in 2000. Hey, we're going to raise rates, inflation's going to remain running at, above target, we'll pause, and then we're going to cut rates even before inflation starts to fall. You see that again here going to the global financial crisis. You see that, of course, looking around 2019, and you see that now. Inflation clearly coming down. We're clearly seeing disinflation. Fed still got the foot on the gas when they should be pausing and cutting before the banking system blows up. If estimates of the neutral rate of interest shifted higher, officials could conclude that the rates needed to slow inflation would be considerably higher. Those estimates haven't changed, and the funds rate might be expected to return or go down. Nobody making the case to zero. Of course, perhaps that says, yes, we're going back down there at some point during the next crisis. But the notion that the Fed can raise rates and quench inflation is just a myth propagated by central bankers. But what do you think? Do you think that's true, or do you think the Fed really has control of inflation? Because now all of a sudden we're hearing from Powell that a pause may be the case for June. As Powell signals a June pause, says Fed can afford to watch the data. We've come a long way in policy tightening, and the stance of policy is restrictive, and we face uncertainty about the lagged effects of our tightening so far. No surprise, they're bad. And about the extent of credit tightening from the recent banking stresses. Having come this far, we can afford to look at the data and the evolving outlook to make careful assessments, he said. This from prepared notes, not off the cuff. As the financial stability tools help to calm the conditions in the banking sector, develop developments there, on the other hand, are contributing to tighter credit conditions and are likely to weigh on economic growth, hiring, and inflation. As a result, our policy rate may not need to rise as much as it would have otherwise to achieve our goal. Of course, the extent of that is always and is highly uncertain, he said, and as it always is with the Fed, it's uncertain. But what we can note here is we're starting to see even the Fed is starting to believe that they either have gone too far or they're really not having effect. Of course, they'll never admit that they're having no effect on inflation, but what we can note now is the issues in the banking system are not going away. That may be what they're actually seeing now and starting to wonder, if we keep tightening, does it mean more banks blow up? Well, it does. But the question is, will more banks blow up even before the Fed cuts? I think they do. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.